Okay, so now let's try to understand about notes receivable through the real world example and then the textbook concept. Let's take the scenario of Microsoft company who sells the softwares to a corporate customer for $100,000 and receive a 6-month promissory note at a 5% interest rate per annum, which is the market rate. So basically the software has been sold to a customer at $100,000 and instead of paying Microsoft $100,000, the customer has given Microsoft a 6-month promissory note with a 5% interest rate. Now the note is the interest bearing and collection is expected within 6 months. So it is classified as a current asset. So this is the definition of current asset, that the assets which are going to materialize within going 1 year, then they are treated as a current asset. So this is a 6-month period promissory note. So this is a current asset. Now Microsoft records the note as its present value, which in this case is approximately $102,000 and 500 including accrued interest. So the Microsoft will go and record this at $102,000. Then how this $2,500 is being calculated? So let's go and see this thing. That the face value of the note as of now is $100,000, which is the principal amount as we know. Then the interest for 6 months at 5%. So approximately you can say if this is $100,000, then on $100,000 you can calculate 5%, which and that is for 6 months. So if you calculate both of them, this gives us 5,000, and if we solve this, then we get 2,500. So this 2,500 is the accrued interest here, which was also shown here, that overall the value of this note is 100 and 2,500 here total. So this is the accrued interest. So effectively, if we say what is the total present value of receivable, we can simply say it's around 102,500, which is recorded on the balance sheet as a current asset. So what are the note receivable? Effectively, these are the receivables which you are going to receive in future, which contains many a times the interest rate, or which may not contain interest rate, but in our case the interest rate was covering here. And after containing interest rate, what is the final overall value which you will receive? That becomes the overall value of that note. The key points to focus here is like unearned interest and financing charges are deducted if necessary to state the note at present value. This simply means that there may be situation like the company or the firm which is giving you note, and you are going to get that note, but for getting that note there may be some operational charges or financial charges. It is just like you go to the bank and get a loan, then bank charges you processing charges. So similarly there may be financing charges. If in the above questions there would have been some financing charges, then they would have reduced from this overall $102,500. So they would have been reduced, but right now no financing charges are there, so we are not considering that. Similarly, no interest bearing or below market notes requires imputation of interest using the effective interest method. So basically, in case the note is not having the interest rate stated on it, which is like you are going to get $100,000 and the question says that no interest rate is there. Now let's see that in the real world what happens. You receive the money today versus you receive the money after 6 months. The today's money's value is higher against the 6 months money value, because today if you get this $100,000, then you can invest it into the bank, and from bank you will be getting the interest. So after 6 months this will become $102,500. So effectively, even though the interest is not given in the question, or non-interest bearing, I can say, notes are there, you need to calculate the interest based upon effective interest method, which is a concept in detail which will be covered in future chapters. But overall, even though you are having no interest bearing notes, but at the same time you need to calculate the interest, because in reality the transaction is like this: you get 100,000 today versus you get 100,000 after 6 months. There is a difference in both of them because of time value. And lastly, the interest bearing note issued at market rate are recorded at face value plus accrued interest. This is the thing which we have seen above, that the note which are having the interest rate, then they are recorded at face value plus accrued interest, which is the face value plus accrued interest as we are showing here. Okay, now let's go and try to see the textbook concept against it. So textbook simply says about notes receivable that there is a clear definition that note receivables are return promises to pay a debt. Simply in our example above, Microsoft has given a software and that corporate client has given Microsoft a notes receivable in return. So basically that corporate client is promising to pay the debt or the money to Microsoft evidenced by a promissory note. This is a promissory note basically, and they are classified similar to accounts receivable. Why? Because you are going to receive the money from some other people, and generally the tenure of them are below 12 months. So if the tenure is below 12 months, they are treated as a current asset. Now what they are saying that this is a current asset if collection is expected within 1 year or operating cycle. As you know, this is the definition of current asset. But in any of the cases, if the asset is not a current asset, if they are occurring even after 1 year or beyond the operating cycle of the company, we can call them as a long-term asset. So this is the overall definition of notes receivable as per the textbook.